Hello everybody. I'm making this video because sometimes I encounter people asking me the question about how much money can you make by trading options. So in this video I'm just going to talk about this topic. Hopefully this will answer your question. So this really depends on how much experience you have and how efficient your capital is being used to work in your favor. Let's move on to the next slide. I am speaking from my own experience because I am not pulling this out from thin air. This is all coming from my years of 20 years plus 20 plus years of personal experience. If you trade once every 60 days, you can probably make roughly 8% gain from the capital you put in. I'm only saying this because you really have to do it conservatively. You don't want to take the risk that you cannot afford. Now the methodology I'm using, should you do put or should you do call? Generally speaking, I want to be on the put side rather than on the call side. There are several reasons behind this choice. The first reason is that the stock market is an uptrend. Is in an uptrend in the long run, such as a 5 to 10 year period. It always works best if you constantly long the market. That means if you're on the long side, let's say you sell puts, or you buy the stock outright, all these strategies will work for you. On the call side, you can only buy to go along with the uptrend. If you buy the call, if the market is continuing going up, of course, if you catch that market uptrend moment by moment, of course, you're going to gain. However, in reality, that is not the case. Even in a bull market, it doesn't show you that it looks like a bull market until you realize it a couple of months later, the upward trend has established. By then, you're going to think you're too late, But the reality is that you can't use long call. In other words, you cannot buy the long call, try to catch the market at a uptrend motion. So in this case, I would usually do the conservative way. Instead of buying calls, you sell puts instead. So that's my strategy. The methodology, next topic is a put or call. Again, number 2, the reason for why I do the put is that the market is unpredictable. I'd position my strike in a far out of the money put position, such as 92 or 93% out of the money probability. This way, the option position will provide me with a certain amount of protection from possible assignment. Let's go on to the next one. So, number 3, what is assignment or exercise? Any option you sell, or any option either put or call you sell, that's a short position on that strike, either call strike or put strike. Any of those short positions bears the possibility of getting assigned. When your option strike is in the money, in other words, if you're in the put area, the underlying stock goes downwards towards your position. Eventually, your position is no longer out of the money, but it's in the money. That at that time, you will have the possibility being assigned. It's not necessarily a bad thing, but I'll explain to you maybe in a different video. It depends on how deep the option is in the money. Your gain or loss scenario can vary greatly. In this slide, I would point out when you are at the out of the money put positions, in this area is the out money in the put. See, the put is indicated right over here. See, there's a little red square. And this, all this white area, it could be a little bit further down there. This only shows a certain number of strikes. So as long as your position is in the white area here, your put position, at the expiration, you're not going to be assigned. You're going to just take your money and run. So you're profitable. You are making a winning trade. If your put position is inside here in this yellow area, well, it could be sometimes in different platform. It's a dark area, like gray, whatever the color is. You're in the money. That is when you have the possibility being assigned. When it's assigned, that means you bear the responsibility to buy the underlying stock. Being doesn't matter what price it is. It's gonna be, could be at this point. Could be at this point. It has to be this strike. Okay, let's say you're at 975, right? 975. So that means you have to be purchasing that stock underlying at a 975 per share. If you have one contract, you have to purchase 100 shares. If you have two contracts, you have to purchase 200 shares, because each contract equals to 100 shares of a stock. I hope that's clear. So in the call area, you can see that this area is out of the money. As you can see, this little red square that shows calls, and this colored area is the in the money. Okay, if you purchase a call and this stock market continue to go up, of course your call price will go up, your strike price will go up. Therefore, you make money when you are buying the calls. However, when you are selling the call, the effect will be opposite. When the underlying is going downward, you bought the call, you're going to lose money because the option value is going to decrease. Therefore, you're losing money in the outside of the money. In the put area, I'll go back to put again, is the opposite. If you're buying the put, the stock continues to go down, and your put will continue to increase in value. Therefore, if you're long in the put, you're making money. The opposite effect is that when you're selling the put, even if you're out of the money, not in this colored area, in the white area, your option could at one point be more expensive than you sold. Therefore, on the paper, you're losing money. However, It all depends on at the expiration where your strike is. If your strike is in the white area continuously, although at one point it increased the value, but now it's going to be 0. Even if you write here, write one strike before at the money, this is ATM, it's called at the money. Even if you're here, it is going to be still 0. So if you sold right here, you're still making money. If you sold right here, no doubt you are making money. Let's move on. The next slide is that if your option position is out of the money all the time, like I mentioned before, during the expiration date, during the expiration or until expiration date, you get to keep your premium as well as your initial capital. In other words, that's what I just said, is that if you're in the put area, you sold the put somewhere over here, the price could fluctuate up and down, but at the end of the day or the end of the expiration, your positions outside of the money, you are not going to be affected. You're going to still keep your premium, the premium you sold it to the buyer, and you get to keep that. And your initial capital you put in as what is called the buying power effect, that will return to you. So you don't lose a penny. Instead, you're making money as long as your position is outside of the money. Okay. So that being said, if you are consistently making winning trades, your account will compound and accumulate into a larger and a larger amount. In other words, let's say you have $5,000. You continue to trade one trade after another. Each time you make 8% of your white $5,000. And next time you trade the second time, of course, it's going to be based on 8% gain that you trade, make a new trade. Therefore, it's going to be 16% higher next trade, so on and so forth. So over the course of a year, you could, if you make 6 trades per year, you could make substantial amount of gain. That means could be like a 48% or 50% gain of your initial capital. Thank you.